Welcome to Buzz House, a Baker Tilly podcast. Baker Tilly is a leading advisory, tax, and assurance firm dedicated to building long-lasting relationships and helping you win now and anticipate tomorrow. In this podcast series, developed specifically for professionals in the multifamily housing industry, we'll take an inside look at the topics and issues facing multifamily housing professionals today, tomorrow, and in the future.
Hello, and welcome to this week's edition of Buzz House, our Baker Tilly podcast where you can find all the buzz affecting multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice, and I'll be talking with my cohort and partner in Garrick Gibson, who also specializes in consulting on multifamily transactions around the country. Today we have a guest in the Buzz House to talk about historic tax credits, a tool we have seen in many multifamily housing projects, both market rate and affordable. We're excited to have Stephen LeBlanc, a director with Stonehenge Capital, with us today. Before having a discussion with Stephen about the historic tax credit equity market and where we are at today and amidst COVID and so forth, we want to cover a few recent happenings around the multifamily industry. With many people working on potential 2021 local housing tax credit projects, we want to let you know that HUD just came out with its 2021 list for difficult to develop areas, or DDAs, as well as qualified census tracts, or QCTs. These are, of course, effective for allocations of credits or bonds issued after December 31st, 2020, where you might be able to obtain a 30% basis boost for your project. So look for those, and we can have a link to those as well on our website. On another note, with wildfires out west, the recent hurricanes, the Iowa derecho, so many natural disasters here around the country, Senator Wyden of Oregon recently introduced a bill that would increase local housing tax credit allocations in those states that are hit with these natural disasters. Wyden's bill included disasters after January 1st, 2020. It would be as much as a 50% increase in allocations in those states. There are other disaster bills floating around as well, so we'll keep you up to date on anything coming out of that, any additional credits for those specific states. Switching gears to public housing, HUD issued on September 18th PIH Notice 2020-26 to give supplemental COVID-19 guidance. It covers dollars from the CARES Act, suggestions for alternatives for resident meetings around COVID and so forth. HUD had last sent out COVID-19 questions and answers at the end of May. On another note, NCSHA released a report on September 28th that estimates U.S. renters will owe up to $34 billion in past due rent when we come to January of 2021, the date the current eviction moratorium created by the CDC ends. The report projects around 8 million renters could be facing evictions when this hits. Of course, NCSHA and other advocacy groups are asking Congress to set up some type of housing assistance fund in the next COVID relief package. Garrick and I will keep our eyes on this topic and report back to you as well with any updates. Finally, with many people in the affordable industry asking about where are we at with a 4% fixed credit rate, the Affordable Housing Tax Credit Coalition recently teamed with the Housing Advisory Group for a virtual event, inviting various legislators to speak. There was robust discussion about looking for ways to attach this 4% fix to various COVID-19 packages pre-election, potentially looking at any tax package that could come in December with various extended provisions. This is still in the forefront of many housing friends in both the Senate and the House on both sides of the aisle as well. So we'll keep you in the loop on what's going on with a 4% fix. Now, we want to bring in our guest, Stephen LeBlanc with Stonehenge. Stephen, just to kind of start out, could you just tell us, listeners, a little bit about Stonehenge and a little bit about your role with Stonehenge?
Sure. Thanks, Don. And I appreciate you and the Baker Tilly team inviting me on this morning. This is an exciting opportunity. Obviously, we're living in a very unique world right now. So happy to be here and have been enjoying the Buzz House podcast myself. So, so Stonehenge Capital, the company that I have the opportunity to work for, is a specialty finance company We are co-headquartered in Baton Rouge, Louisiana, and Columbus, Ohio. We're a specialty finance company that spun out of Bank One. Bank One is sort of our legacy. 20 years ago, the company had the opportunity to spin out prior to being acquired by ultimately JPMorgan Chase. And since then, the company's really, for the last 20 years, operated at the nexus of finance and community development through three core business lines. I've actually had the opportunity to work for two of those three. Our community development group is responsible for managing our federal and state new market tax credit allocations. Our growth capital group oversees more traditional debt and equity investments and some state targeted funds that we manage. And then our tax credit services group, which is the group that I work for now, oversees all of our various federal and state tax credit investments that we have the opportunity to invest in nationwide. So specifically, my role within the group today is I lead the originations and acquisitions of our historic and other tax credit opportunities that we see all across the country.
Thanks. That was a great intro, Stephen. That was a lot of information for our listeners. We can go ahead and probably jump into some specific questions that we have now. So given all of that and your introduction there, and maybe for our listeners to really sort of understand the equity market in this space, what's the difference between a broker, a consultant, the investor syndicator, fund manager, and all the other fund words that are typically used to describe where all the tax credit equity comes from in these transactions?
It's a great question. It's one that I feel like we, within our own industry, completely understand. However, when you kind of reach into the broader market, especially the more traditional multifamily developers that we have the opportunity of working with, they're often a little confused of who's who. So I'm not sure if there's an encyclopedia for the tax credit world, but generally speaking, I would consider, the investor would ultimately be the end user of the credit. So you may have a direct investor. So you'll see some of the large national banks, maybe some insurance companies, other corporates will act in that kind of direct investor capacity. So that's kind of one category. Broker and or consultant may strictly be working on a commission type basis where they're responsible for matching a tax credit investor. So again, the end user of the credit. That could be a direct investor with a project and ultimately its needs. The difference between the broker and the consultant is the consultant may also provide some advisory services to ensure that the developer is completely aware of what they're getting into and the like, whereas a broker may solely be making an introduction. I would say that Stonehenge fits more squarely in kind of the syndication and or fund manager route where that means we're essentially, managing proprietary funds on behalf of our institutional client base, which includes banks, insurance companies, and corporations. So ultimately they've come to Stonehenge to provide a service. They've capitalized certain funds that we manage, and we're, managing that money on behalf of our partners. Generally speaking, we are given a box to operate within, to originate, structure, close, and asset manage these deals, which is kind of a big distinction, given that, in the broker consultant world, you may never really know if you're a developer, who it is that's going to be managing this asset, who's actually a relationship. For us. The way that we've built our federal equity platform is that we wanted that continuity, that sort of kind of, seamless transition was important to us. And so when we built our federal equity platform, I don't know, maybe back in 2014, when we really got into the federal equity world. Prior to that, we had been active in the state tax credit world. We can come back to that in a minute. But once we got into the federal equity, we wanted to be a little bit different, offer, kind of top quality service to not only our institutional partners, but also to developers. And part of that is giving them a clear sense of who they're going to be working with, kind of from A to Z. And so that's sort of how we've set up our practice. It works. I mean, I think everyone has their own niche, and there's, roles that everyone can play. But for us, having the ability to control the capital, to have that box, as I mentioned, to invest from is really important to us. and helps us, we think, be a little bit more efficient in what's, in my opinion, somewhat of an inefficient market.
Yeah, thanks for that. That was great. I mean, that gives kind of a good sort of view for developers to understand sort of the players and the complexities that might be involved with these types of transactions. So given that, so what typically are you looking for in a deal? If somebody's coming to you looking for equity, I mean, like for instance, location, size, like developer experience, their sophistication level, or even just assembly of this professional team?
Yeah, so right now we have the good fortune amidst all of this uncertainty in the world today to actually have access to a handful of proprietary funds. So proprietary meaning the fund is closed, the investor's capital is committed, and essentially we're out deploying capital. And so right now we manage funds kind of that can invest in projects that generate federal credits from $1 to $3 million, maybe $3.5 million. And then we also manage funds that can invest in $4 to $12 million type opportunities all across the country. It's really there's really no specific footprint that we try to stay within. Obviously, your better real estate markets are generally where we would want to be. So your kind of top 50 MSAs would be a focus. But again, our company, being based in Baton Rouge, Louisiana, and Columbus, Ohio, certainly understand kind of the college town, if you will, or smaller city, kind of makeup and kind of the way in which those cities flow. New Orleans has been a place that has used the historic tax credit really well. We actually do have a production office based there, and have done a lot of work in New Orleans with the credit. But geography, we're sort of everywhere from California to upstate New York to Florida. We'll really look at a deal anywhere. For me, part of this is making sure you have an experienced developer. Some of the more technical aspects are important, but then for us, also trying to identify, clusters of projects. Really, again, we're a small company, 50 people in total, about 12 people in our group that manage our investments. And, for us, trying to have, a handful of deals in a market. So it's always a great opportunity when you can kind of cluster deals from both the origination and business development all the way through asset management. We're not trying to pick off deals and here, there, everywhere. Not to mention some of the more rural markets where we are seeing deals. We would very much, and we have through our other business lines, been very active in investing in low income and rural areas. But from the real estate side, it can be a challenge, especially when there's a kind of a smaller downtown that might be on the upswing of sort of the reurbanization of that downtown, and the developer wants to put 100 multifamily units, and there's no other comparable because the town only has 20,000 people. Those deals are out there, and they're somewhat tough to pull together because we do, as I mentioned, we do manage institutional capital, so they expect institutional type credit quality from us, and so truly underwriting the deals is something that we do try to do. So, Garrick, to your point, what else we're looking for, if they have a market study, if they have a pro forma that's, within reason, all of those things are important. The experience, while yes, we do probably have a preference for, developers with historic tax credit experience, an experienced developer that recognizes the need to have the right professional team. Professional team would include their advisors from Baker Tilly that'll provide, their initial, advisory and consulting services up front. I think it's very important, and we can come back to that in a minute. And then, having the right legal team in place that'll work, in coordination with the Baker Tilly. And then having a preservation consultant, architect, general contractor that really has that team that comes together that's ultimately going to be responsible for not only closing the financing, but also getting the project to completion and ultimately leased up. So those are all things we like to see. I mean, oftentimes I find myself trying to encourage developers to retain at minimum, Baker Tilly and the legal firm, spending, a few $1,000s to retain them with a deposit is always a good sign. And for us, it's critical to have an understanding of what it is they're trying to accomplish, and really having the right accountant and legal team on board early is paramount in our minds.
Yeah, thanks for that. I mean, obviously, in historic transactions can be, require some level of sophistication. There's a lot going on. So, assuming you've sort of identified a developer and they've had some initial discussions with you, how should they technically approach you with the specific investment opportunity in terms of like delivery of information and should they already have a structure in mind? Should they be running their development models with some type of pricing assumptions? Obviously, if they're working with a Baker Tilly type of consultant already, maybe some of this is sort of hashed out. But what are you really looking for them to deliver to you on that initial delivery of information?
Yeah, I think it's really kind of all over the place, Garrick. We're happy to look at a deal, in pre-development if the developer is just trying to get a sense of where, market pricing may be as they're putting together a pro forma very early on to determine whether or not the deal is even going to pencil. So we're happy to start the conversation there, or in certain circumstances, you may have a project that's closed to financing and they're bringing in their tax credit equity partner at a later date. So for the timing, we're happy to kind of help out anywhere in between. But most typical, we're going to be closing our financing alongside of the construction loan and other financing. So, really, it's pre-COVID, post-COVID is probably two different things. I feel like the evolution of the Zoom call and FaceTime, what ordinarily may have been a little taboo prior to March, is now a way in which I'm meeting a lot of first-time developers where I may have met them either A, at a conference, B, at some other sort of developer-type symposium or something where there's more personal interaction, or, being in market where you have the opportunity to make direct outreach to get in front of these folks. Now it's doing a lot of phone calls, emails, a lot of Zoom, a lot of FaceTime, and the like. So we're happy to accept, just a call to have a chat, bullet points. I get it every which way, honestly. But I mean, a professional package that shows there's been thought and consideration is definitely something that gives you another comfort level, I'd say, that the deal is going to be executed, fairly efficiently, right? I'm not saying that a deal can't get closed if the first thing I see is 3 bullet points, but when I get delivered a package that shows the thought, shows, and it can really answer a lot of the initial questions regarding just what is the project? What are you guys trying to do? How many units is it? Is there a need for housing? Stuff like that, I think it's definitely helpful. For us, it's our industry. I think the federal historic market has generally hovered right around about 1 billion credits a year. That's 1 billion. According to NPS statistics, it's kind of gone from 900 to 1.2, and maybe it's kind of moved around. So, which I believe is one of the smaller of the federal tax credit programs that are out there. So it can be competitive. So for that, we want to have conversations as early as possible. And I recognize that not everyone's going to put together a 30-page, deck because they have a great relationship with the local lender, and the local lender has never required it. So why would they do it now? So it's really all over the place. I don't know if that answers your question, but it really is quite amazing the vast array in which we receive the information, having projections run. So that's very exciting, by the way. When I get a deal with, a nice deck that may have some pictures in it and a Baker Tilly, structure diagram and, mini model or short model, whatever you guys call it, that is something that does get me pretty excited.
That was really, really helpful, Stephen, I think for those on the listening in as well. So I appreciate that. Stephen, you did mention, pre-COVID and post-COVID. Let's say we have some listeners online today that, maybe closed a deal a year ago and now we obviously are well into 6 months into COVID. Are investors looking at deals differently? Are there other reserves? Are there different structures? Has COVID impacted, or maybe it hasn't, but on the historic side specifically, has it impacted kind of your underwriting or the way you look at deals and structures? Yeah, certainly.
We are living in sort of a different time right now. So I think that everything, has changed to some degree. So obviously asset class is an easy one to tackle. I don't think there hasn't been any sort of lack of information regarding the struggles that the hospitality industry is going to, face, over the next kind of 12 to 18 months. I think the hospitality sector, but hotels, short stay rentals and the like might have some struggle. So that's going to be something that we'll approach with caution. I'm not saying that we're shutting it down. I mean, the hospitality projects we are looking at currently have great locations and may be coming online, not in the next 30 days or 60 days, right? So you're looking sort of in the future. We are relying on some third-party reports from HBS and Smith & Travel to sort of determine what the recovery of the hospitality industry looks like. So that's hospitality, commercial, and office. We really want to see that the project has some leasing activity. We completely understand that, it's tough for a commercial broker to get tenants excited about a vacant building that's been vacant for 15 years. And they're about to close the financing and all of this, but it really does make it tough. As I mentioned, we do have the good fortune of having institutional partners. And so a lot of times we're following some of their same credit standards that they apply to, their traditional debt product. So oftentimes those are sort of in line with the construction lender. So if you have a, mixed use project, looking at how much of that is commercial space versus, the residential, and then how much of it may be pre-leased or, is in a great location. There's a lot of factors that we look at, and location being one of them. So that's probably one of the biggest changes I would say is just sort of the, really understanding the asset class, the market, the opportunities for leasing if there is commercial, if there is a hotel, what's their plan. And then we have the good fortune of having a couple of my colleagues, spent considerable time in the development world in the hospitality sector. So we think we have a unique opportunity to look at some of those deals, to look at a P&L, to see where, hey, this could possibly improve when you're looking at the comp set. So right now, again, I think we're willing to look at any asset class. The affordable deals seem to be getting a lot of traction right now. There's a little bit more certainty of execution there. And we've also seen a lot of our developer clients move to the HUD route, which I know you guys follow closely, Don, your practice specifically, you and Garrick work closely there, where the timing associated with closing a 221-D4 loan, I think everyone on this call is very familiar with, kind of that, 300 plus day closing potentially. And some developers have had to shift there just because there is certainty of execution, and hats off to HUD for being very flexible from what I'm reading at my level and kind of seeing. It looks like HUD's been a great partner in a lot of these deals. And for us, we've been working with developers that have gone the HUD route. We are still working with them to get pricing, term sheets in place, structure, entity names that are required for final HUD submission and to kind of help them through the process. So that's been, kind of a place that we've seen an uptick in activity. While it's not great for short-term closing, it's okay for the long run. And I think it'll allow us to see what really kind of materializes over the next 12 to 14 months.
That was really helpful observations there, Stephen. Steve, one other question I've got for you is, Garrick and I work a lot in the local housing tax credit space. Our colleagues work in the new market space. And we've seen, obviously, through the pandemic, maybe there's a lack of equity, maybe tax credit pricing is going down. In the historic space, has there been, major changes, pricing, availability of equity, or how has kind of the general historic equity market been through the pandemic? Any changes that you've seen, witnessed?
Yeah, I think there has been, some downward pressure on the historic credit. There are still a few, for us, we're still having to try to kind of wade through the single year versus 5-year credit. There are still a few single year credit deals out there. I think as most of your listeners may be, familiar, but through the Tax Cuts and Jobs Act of 2017, the federal credit, was previously claimed in a single year. Now it's claimed over a 5-year. So really trying to figure that out first. Again, that's where having good advisors to help developers think that through, as that can really impact pricing. But you have seen price come down a little bit, I would say, for 4 or 5-year credits. And then, really what we try to do, Don, is to really understand what the project needs. And so this kind of goes into one of maybe Garrick's previous questions, but if they can come to us and say, here's where we are in the capital stack, we have, a bunch of sponsor equity, or the lender came in light on proceeds, or just really understanding where they are, we can tailor a solution that kind of fits what they need. And so, and what I mean by that is, not every deal, believe it or not, needs the highest price per credit or the pay-in schedule. They're all so very, very different, and really trying to satisfy, their needs is something that we want to do, but it's really tough to do when you don't have a complete picture. And that complete picture, in my mind, is best drawn with assistance, the developer's assistance from an accounting firm and a legal firm that can help them say, hey, you don't really need, that much equity to come in right there. Obviously, everything we're doing is compliant with the revenue procedure, but within that, if we can knock the preferred return down a little bit, and if the price goes down and the pref goes up, there's a lot of things that we can do to basically get the developers what they need. If they can come to us and say, hey, here's my situation, here is the structure that I'm looking for, here's why I need it. It makes my job a lot easier, and it takes out a lot of the guesswork. And so, the pricing has come down. I don't think it's been really too dramatic. Maybe it's come down a couple of pennies, and some of that is because of the uncertainty. Some of some of these institutional partners of ours, do have considerations to deal with of potential tax liability in the future. So. That is something that we are cognizant of, and we are monitoring closely to see what the market's going to do.
Very good. A lot of really, really good and timely information, Stephen. We appreciate it. We'll definitely, I know we even probably cover everything we want to cover, but we'll probably try and bring you back into the Buzz House at some point to ask you some other questions and some state credits and things like that. So thanks again very much, Stephen, for joining us in the Buzz House today. And listeners, thank you for tuning in as well. And feel free to reach out to Stephen LeBlanc. We'll have his contact information on our website, or Garrick and I about today's podcast and historic credits, or anything on your multifamily developments you're contemplating. Again, please check out bakertilly.com for any resources around COVID-19 and the pandemic. And as always, if you have suggested topics, please send them to build@bakertilly.com. That's BUILD@bakertilly.com. Thank you.
Thank you for joining us today. To receive notification when new episodes become available, please subscribe to Baker Tilly US wherever you get your podcast.